Today, we have Nick Desai, a serial entrepreneur with multiple exits who has raised over $250 million in his career. He's the co-founder of Together by Renee, an AI-driven health tech company that has recently raised a total of $8.8 million. Nick shares his lessons learned raising capital and what it was like being a .com CEO, feeling like a celebrity back in the heyday, to raising capital in today's market. Nick's story is unlike any other guest we've had on the podcast, and I hope you are as engaged as much as I was when I got to interview him. Let's go ahead and get started. Hey everyone, welcome to the show today. Today we have Nick Desai with us. Nick, thanks for joining us.
Great to be on the program, Jason. Glad to talk to your audience.
No, I'm excited to have you on the show. You have an incredible background. Extensive background in the healthcare space. Currently CEO Together by Renee, which recently raised $8.8 million in total. But Nick, you have an incredible track record of fundraising. You mentioned that you've been raising capital every single year since 1998. You have such an incredible story to share. I would just be happy if you could just dive straight in, give us a little bit of background on yourself, what got you into the world of entrepreneurship and raising capital.
Yeah, look, I have wanted to be an entrepreneur ever since I can remember, since I was a little kid. My father had his own business, my grandfather had his own business, and it's sort of all I ever knew. And in fact, I distinctly remember it was in high school that I realized that it was possible to do something other than just start your own company, right? It was, so I went to college and grad school, finished my graduate degree in electrical engineering at UCLA, and then I worked for a couple of years at Rockwell Science Center, and as an actual engineer, a couple of years in management consulting, and then I started my first startup. And people always think, oh, you learn more as you go, and venture pitching, and I didn't know anything from anything. I was in Los Angeles, and A round, B round, C round, F round, seed round, convertible note. I didn't know anything. I didn't know any of the terminology. I was 28 years old, 28 years old, and we had this idea, and we had an angel investor, which was just a really rich guy that my co-founder and I knew, that put in $100,000 and helped sort of get the company started. And we went to pitch Draper Fisher Jurvetson, right? And there was an event in LA where I got in contact with him. We went to pitch him, and by the time we got back to our office, and just to date how far back this is, we had a term sheet faxed to us, right? So one pitch, term sheet in. I was like, this is great. This is easy. And so that was my very first true fundraising experience. And there have been great ones since then, and really arduous rounds since then, and everything in between.
And so that was 1998, you mentioned. That was when you got your first term sheet. So I guess kind of walk us through, what was that first company, and kind of what was the outcome of that, kind of going into the .com boom and coming out of it?
Yeah. So, it was interesting because I was this, 28-year-old guy, and I always tell this because I was single then, and I was a pretty nerdy, dorky guy, and an engineer, and not really like smooth with, ladies or anything. And all of a sudden I'm a .com CEO, and that became like a celebrity back then. It was this weird time in industry and in America, where everything internet was like, now still tech moguls and tech companies are looked upon in a number of ways, but they've started more normalized into society, whereas back then it was just very brand new. And so the first company, the idea was an extremely simple one, which was a self-updating address book on the internet, right? So when I update my contact information, if you're in my contacts, you automatically get the information. It's sort of an idea that we could all, still relate to now. Now we have LinkedIn and email and social networks that sort of serve that purpose. But that was the very first idea. And my co-founder and I, we talked to, as I mentioned, a rich friend of ours, and they and a few rich friends of theirs put in some money, and we really didn't know like what the structure should be or what. And then we got Draper, and then I learned the process as we go, right? And the value of investors and professional investors in particular, which is not just that you have the capital to build your company, which is obviously important, but that a professional investor brings with them expertise, brings with them contacts, brings with them hiring. Just because you start a company doesn't mean you know everything, right? Legal structure, what's a good law firm, how to patent something. The things you don't know, often a good VC can help you do, can help you figure out, can help you, stay grounded, yet, sort of continue to pursue your passions. And so learned all that process and then, been doing it ever since, right? And interestingly, that company grew and grew and we should have, there was a point at which we had an opportunity to be acquired at a very, very, very favorable terms, like great returns for everybody. And it was sort of the last end of the .com sort of boom, right before sort of the bubble burst. And our board did not think we should take the deal. And so we didn't. Ultimately, we sold it and got a lot less money someplace else. But one of the lessons I learned there is, I distinctly remember this board call where all the VCs were like, Nick, if you say sell it, like if your heart won't be in running this, if we don't sell, then we'll sell. And I made a stupid mistake then. I said, guys, I would never leave this company. It's my heart and my soul. Instead of saying what I should have said, what was in everyone's best interest, which is, yeah, sell it, right? We're never going to get more money than this. It's time to sell. Let's move forward, right? And so that was an important lesson that you have to speak up. And there's a certain amount of obviously respect and professionalism, communication, information, financial statements, all that stuff that you should properly provide to your investors. But there's beyond that, there's a point where you can't be so reverent that you're not acting in your or their best interest.
No, that's incredibly well said. And you bring up an interesting dilemma that I think often happens to a lot of founders where they're kind of conflicted on, there's kind of like a double standard where like there's shareholders' best interest. You have a fiduciary responsibility to your shareholders to provide the best possible, returns. But then the selling mean you're selling short, you kind of cutting out early, you quitting, you leave money on the table. There's that kind of second guess. And it's hard to know what was going to happen eventually, but when everything's going up into the right, we just had an event like that in the last couple of years where a lot of founders are probably regretting the decision to keep at it or not to raise capital in those markets when, it was flush.
Yeah. And sorry, go ahead.
Well, what I was just going to, go into is, kind of going from that experience, you mentioned you've been raising capital ever since, every single year. Does that get exhausting?
Look, people talk about fundraising as exhausting or time-consuming or annoying, and there are times when it certainly is, right? There are certainly times where, like, God, especially nowadays when you have Zoom, right? Because it used to be, you'd be in Silicon Valley, you'd go up and down Sand Hill Road to the VCs or in New York or in LA, more in Silicon Valley than any place else. And you do 3 or 4 meetings, 2 or 3 in a day. You'd have breaks in between. You're driving, you're eating, you're doing whatever. And now it's like Zoom. And so there are days where I've had 1, 2, 3, 4, 5, 30-minute VC intro calls back to back, right? And you just get tired of saying the same thing. But overall, I would say it's an incredibly important, if you can't raise money, if you can't enjoy the process of raising money, you should not be the CEO of a company. It is the hallmark of a great startup CEO is that you're the one that can raise the money. In fact, a friend of mine who's starting a company and a really interesting company, it's like, I found this great guy to be a CEO and blah, blah, blah. And then that I met the guy and he's really brilliant. It's in the healthcare space and accomplished guy and ran big divisions at huge healthcare companies or whatever. And then he said, would you consult with me to raise the money? And I called my friend who's the founder of the company and I said, this guy cannot be your CEO. He can be a COO. He can be a president. But the hallmark of a CEO is that they can raise money. And to me, if you're not pitching to an investor for an active round, you are passively pitching them, like getting to know them, staying in touch with them, keeping updated on your progress, all that stuff, or you are defensively pitching, right? My wife is my co-founder. When we first started pitching, she's like, these guys are never going to invest. I'm like, yeah, but if they hear our story and they like it even if they don't invest, when our competitor comes in the room, they're going to remember us and think, well, if I do want to invest in this space, Nick and Renee are the way to go, right? Whether it was Heal or Together or whatever company. So overall, I enjoy the process. I enjoy seeing how investors think. I developed for myself a clear picture of the difference between what, investors' jobs are to make returns on their capital. To expect anything else, yes, they can help you. They can be good advocates. They can do whatever. But ultimately, their job is to turn the $1 million they put into your company or $10 million they put into your company into 100 times that or 1,000 times that, right? And that is what their motivation is. They're not your friends. They're not your parents. They're not your brother. They're not your counselor. They're none of those things, right? And once you understand that relationship and treat it with the professional respect, but also independence that it requires to be successful, it's also an enjoyable process. And learning from and speaking with investors is an important part of my day-to-day work.
And, you brought out something interesting there. And there's something I was going to bring up in this conversation is the fact that you co-founded, multiple companies with your wife. What's kind of been that experience, kind of having you and your partner in the trenches, building companies and raising capital together? And has it ever been a friction point for investors?
Well, so the answer, I'll answer that last question first and say yes. When we first started Heal, so this is going back 9 years ago, and we went to one of our we raised angel capital first, and that was a really fun experience. We should come back to, because we got some cool celebrities in that, and it was a sort of a wild experience. But when we went in to meet one of our first, and we were an LA-based company that was doing something really interesting, meeting an LA-based VC, right? We walk into the office, and we won this Montgomery Summit competition. We walk into their office, and the partner from this venture fund turns to me. So first he says, look, we don't do husband-wife team. We won't invest in other, we look down upon that, right? And the insane part of that statement is I could go to any co-working space or coffee house in the Bay Area, meet some dude, start a company with him, know him for like a week before I start that company, or go to a hackathon, meet someone, know them for a day, and no VC is going to ask that question. But my wife, with whom I raised 3 children, and we've been through, ups and downs of life, that's a negative. But then the real turnoff was when he turned to me, looked at me, said, well, what if you get sick of working with her? And I did like 2014. I'm like, hello, 1976 would like their sexism back, please. It was absurd. But today, it is not, it's changed a lot in the 9 years, and a lot of VCs look very favorably upon, or at least equally upon. Nobody asks the question, right? What are the negatives or what are the downsides of? People ask, what's your working relationship? What is it like? How do you resolve conflict? But in no different way than they would ask if any other co-founder, right? Plus, we succeeded in doing it in one company, and we're doing it again. So it's also less of a question this time around, right? In terms of what it's like, it's great because Renee and I build health tech companies together. She's a doctor, and she cares about clinical and making great products and serving patients and helping people, and all that stuff is really important. And I'm not saying this in a way to sound like I don't care about that, but I don't know how to do that. I'm not a doctor. I don't know how to treat a patient. I've never been wearing the white coat when somebody walks into an office hurting, right? I've been a patient, but I've never been a physician. So my perspective is the outward-facing stuff, raising money and managing engineers and creating innovation and keeping a perspective that we can't, we may not build the perfect thing day one, but if we don't build something, there's not going to be a day two.
Clearly they have the track record working together, and it's impressive to kind of see these types of stories come out and be more of a normal and acceptable path for founders to build companies. Because I bring this up because I've seen this happen again in the past where VCs like that you experienced kind of brought up these points, and I'm just like, to counter, as you kind of said, like there's so much more cohesion and understanding between a married couple than there is the person you pick up on the hackathon to start up a company. You have no idea what you're getting yourself into. So appreciate you sharing those insights. And when it comes to, back to back, you went from Heal to now, actually you mentioned you had an interesting story about the angels. I'd love to kind of hear about that. Going back to Heal, you mentioned that was a good story.
Yeah. So the story is it's only good in the way that it's a LA thing and it's a cool thing that happened. It was really fun. But when we wanted to start Heal, I had a work contact and he got a couple of like LA ultra high net worth types to invest, and people started making introductions and they were saying, oh, these guys, there's this company Heal that's raising money. And we met this guy through that process, and he's like, he spends 2 hours on a phone with us asking every question, just not even a seed. It's an angel stage company, right? There's no, every question under the sun. I mean, I was turning into jello answering his questions, at the end of which, and he's supposed to be a prospective investor, wealthy guy. He's like, well, I have no money, but I'm going to introduce you to people that do. And we're like, what the hell did we just do here? And how do we spend our time? And Greg, my colleague, and Renee and I were so annoyed. And so a week later, he calls and says, I need you and Renee at the Peninsula Hotel at 4:00 on Friday. The Peninsula is a famous hotel in LA. A lot of people meet there. And so we went, we waited. And in walks Lionel Richie, the singer, Lionel Richie. I guess there's only really one Lionel Richie, and that's who we brought to the meeting, right? And so we sit, we're talking, oh my God, I'm sitting with Lionel Richie. This is really kind of cool. And so after, 20 minutes of intros and wow, this is really cool, he turned and said, so what am I doing here? What am I here to listen to? And I realized, this guy seems like a really nice guy and a bright guy and passionate about what we're doing, passionate about actually helping people. But he doesn't want to listen to a long story. So I was just like, it's like Uber for Dr. House calls. And I kid you not, Lionel got up out of his chair and he said, I love it. I'm in. How much can I invest? Right. And from that process, we grew and grew and grew as a company, but we also grew and we also grew in the sense that we had a ton more celebrity investors over the, Matt Damon was an investor, Russell Westbrook, Derek Jeter, lots of people like that, right? We found as investors.
And did that kind of all come, so was that coming from that one person you were kind of concerned that wouldn't deliver any value, or did it come from other sources?
And celebrities are sort of, my friend's in, so I'm going to get in, and you know what I'm saying? And for a lot of people, it wasn't that much money, for investing $1 million or $2 million when you have 100 or 500 million is not that big a deal.
Good problems to have. And so tell us about the journey of Heal. I think you mentioned you raised about 15 million for Heal, or is it 200 million for Heal?
Heal was 200 million.
Okay. So talk to us about that journey of like initially raising that kind of, early stage angel capital to kind of what was the trajectory from there in terms of growth and capital raises.
Yeah. So that was the company that Lionel got involved in, right? And then other celebrities. And then we raised, ultimately, then what happened is after that angel capital, we launched the product and people really liked it. And we went to a contest. There's the Montgomery Summit down there. It's an investment banking and VC summit. They have a pitch contest. We won a $100,000 prize in the form of a convertible note that we put onto AngelList. And that note grew without much effort from $100,000 to $13 million over the next several months, right? Sort of a rolling close, money kept coming in and in and in. So that made the fundraising early part really easy. We then raised I want to say $21 million A round. Then Fidelity came in for $15 million in a B round. Then we raised more individual capital, brought in some strategic stuff like that. But our C round, we did a C round with IRA Capital, and Taiwan Sovereign Wealth Fund and people like that. And then we met the folks at Humana in October or November of, I'm just trying to get this right, 2019. And they really liked what we were doing and said, look, this is something we're going to dig into. But at that stage of company and the intensity of the due diligence that Humana does on a company they invest in or did on us is virtually like I've never experienced anything like it, right? It was 6 months of exhaustive proctological digging, right? I mean, every employee we've ever had, everyone who's ever tweeted, everything, right? So it was a long process, but it was worth it to win them as a partner and an investor of $100 million.
And so Humana came in and wrote the big check after 6 months of diligence, and ultimately was it them that came in and acquired you?
Yes, and then about a year and a half, almost 2 years later, they acquired the rest, the part of the company they didn't already own.
And so, how big was the company at that point? And what were some of the major milestones, if you can share them, that allowed you to raise so much so quickly and lead to a successful 9-figure outcome?
It was a combination of 3 different things. It was a combination of ultimately the actual progress of the company in terms of revenue growth, all those, the classical mechanics of the company, right? Growing revenue. We were a Deloitte Fast 500 company. We were the 114th fastest growing company over a 5-year period in North America for privately held companies. We were CNBC. So that was one track. The second track was the fact that we had a really innovative product. Doing doctor house calls, in a way, sounds easy. You send doctor to the patient's house. And that is true, except it's also extremely difficult to make that work in the sense that you have to, if a doctor in an office can see 40 patients a day, a doctor in a home can see 10 patients, going house to house, can see 10 patients a day. Well, how do you make up for that revenue? Well, you have to cut operating expenses relative to an office. That requires real-time eligibility verification. So that requires this. So all the technology we had built was also pretty incredible, right? And then the third thing was the overall market timing, in the sense that we executed well and had a really killer technology at a time when digital health was growing and doing well, and the importance of home-based care was being understood, partly because we evangelized it, but it really made it possible for us to get a great exit. And, we had that sort of trifecta of market timing, great technology, product market fit, and pretty flawless execution.
It sounds like you ran a tight ship and nailed market timing, and exiting in 2021 when things were hot and deals were happening. Sounded like it'd be it was a great outcome. But when most people have big liquidity events, they take time off, they go and kind of live up a little bit. But it seems like you went right back into a very similar industry with Together by Renee. I guess what kind of led you to that outcome? And, kind of switching right back into, a similar business right after the acquisition?
Yeah. So what happened is it was a couple of different factors, right? The first was that it was the middle of the pandemic, right? When Renee and I left Heal, it was still early 2021, and there wasn't a lot you could actually do, right? Lots of things were still closed. We had 3 young kids. I mean, now our daughter is 4.5, but so if I think back to then, she was like 2, she was unvaccinated, even our boys weren't vaccinated. In fact, I don't think there were vaccines then, but I'm mixing up the dates a little bit. But the point is, part of it was COVID, right? Part of it was when you sell a company at that price, you don't, and to a public company, it's like you get your money the next day, right? It's not like you get that check that people always imagine, oh, here's a check. It is much more that it takes time to actually get the payout. So the payout wasn't immediate. And then the third factor was the company we started, this company Together, is an app for aging people and caregivers. And between Renee and I, we are caregivers to 4 aging parents, right? So we were sort of living this experience. It was in the middle of COVID, and didn't have a lot to do. But funny enough, I was just talking to my wife yesterday, right? And we were saying that, if I look back, although this company has certainly, been a great ride so far, if I look back, I think to myself, I should have taken 3 months, even if it was just to sit at home and read and go to the beach near my house and COVID safe stuff and literally just sleep in and, that kind of stuff. It may have been good because it took me, it's sort of the exhaustion of building Heal hit me not right after I left and I started this new company a month later and started raising money for it, but sort of 6-8 months later. And there was a couple months, I would say 2-3 months, maybe 4 months during the process of building this company where I was feeling it. And I know that I was operating at a solid, B, you know what I mean? But I wasn't operating at a normal A+ level from energy or intellect, if you will, that is critical to the success of a startup.
And so kind of that transition period and, looking at making that decision. So you were living an experience, you didn't have all the money come out at the end, which I do want to kind of go back to a little bit more on the story of the, raises and, the exit, just to kind of shed some light on that to founders. Because as you kind of mentioned, most founders think, oh, big payday, get a big fat check, go live your life. But, life gets very, more money, more problems, as they say. And it doesn't always come at once. But, let's talk about a little bit about more of the story of Together and, where you guys are at with the business. How'd you overcome kind of those challenges you just mentioned? And when did you guys go out and raise the first check? Did you guys self-fund? Did you raise institutional capital? Did you raise from existing investors from your past ventures?
For Together, we raised money from institutional investors right away. Given that we were coming out of Heal, it wasn't particularly difficult to do that, right? We probably spent a month or two sort of ideating what the hell this company should be, and then made a deck and then raised money for it. So it was about a 1 month, that was about a 6-week process overall. And then we did a second half of our seed funding, which was a literally 8-day process, which was awesome, right? That was just, that was really great from a process perspective. That was also the sort of peak of the health tech market boom, which has significantly receded since then, as you probably know. But so it wasn't hard for us to raise money in either of the rounds. I had the opportunity early in my career, after my first startup, to meet Trip Hawkins, who was founder of EA, and he was founding a new company. And I said to him, we're like $100 million, $500 million. I don't know exactly, but very wealthy guy, right? I said, what are you out here schlepping for a couple $1 million for, right? I always thought, hey, I'll do a company with my own money. And he said, it is a test. If I can't find investors to invest in this company, that is itself a telling sign. It's easy to drink your own Kool-Aid, to get high on your own, I'm so great, right? Everything I do is going to be gold. But the fact that you have to go raise money, and it's also easy to be lax with your money. I know someone who is taking a bunch of employees to Hawaii, right? For a junket to a really nice resort, and they can each bring up a significant other and all expenses paid for a work planning thing. And the point of that is that when I first heard, I'm like, are you spending company money? This is okay. It's like, no, I have enough money. I'm doing this, right? And I was like, if you wouldn't do it with investor money because you'd consider a breach of fiduciary duty, you should never do it with personal money. It's actually easier to be lax with your own money than it is with money investors give you, because you're not accountable to anyone.
I think that is a very valuable lesson to pass on. And I think a lot of founders kind of get confused by that as well. Like, why is this person raising money when they have all the money in the world?
Yeah.
And I say, I hear the exact same story time and time again. It's just like, it's a point of validation, and that's why,
Yeah.
go and raise. And I've also ran into people that went the opposite path. I just got off the phone with a company that, founders came out of a very sizable exit and were self-funding the business to the tune of $13 million of their own capital, and they're only at $50,000 a month in revenue. And now they're trying to go out for outside capital because they burned through all their own personal capital. And they probably could have got market insights and more validation and maybe made more progress if they weren't funding it themselves. They were joking that they were buying a very expensive sports car every single month as far as burning cash.
Well, it's ultimately, I would say this. There are two critical rules, right, that I think are worth following if you are a repeat entrepreneur, and especially if you have money. If you're an entrepreneur, you are risking your time because you're not taking a market wage, right? People like me, who with the amount of years of experience and whatever I have that worked at Google, would be making a seven-figure, mid seven figures a year, right, with bonus and things. I don't, right? I'm a startup CEO of a seed-funded startup. So either risk your time or risk your money, but don't do both, right? Entrepreneurs should be entrepreneurs, and investors should be investors, right? And the second thing is, investors' money will force you to act with a level of discipline, right? Either the burn is too high, or you nickel and dime it because it's your money, or you go too slow, or you're indulgent of things, or you chase flights of fancy or personal pet projects rather than what you think is the best company, right? And so that is a really important point. It will keep you honest, right? Having investors will keep you honest.
And I think that's probably why you've been successful in raising capital every single year. I'm sure that message resonates with investors that have backed you. And it sounds like those investors have come back to back you time and time again, over the years. So we've kind of heard the story now from 1998 to now, but I would like to talk a little bit more about Heal and, Together in terms of just, fundraising strategy. I know you make it sound like, oh, you raised in 8 days, but like, how did you go about structuring your materials? You have a track record, so people believe you. So it's not maybe difficult to get meetings, but who did you go to? Why did you pick those people? And what kind of capital did you want on your cap table?
Mostly I picked people that were people that I knew, right? VCs that I knew and wanted to work with, right? And so that was a critical aspect of how I Quiet Capital that's invested in our company. It was Morgan Livermore was a partner then, and for Morgan, it was I wanted to work with him. I knew him from when he was at Excel. Amit Garg, who was at Tau Ventures, same thing. And then people refer you, and then it just grew from it just grew very quickly from there. In terms of the structure and the pricing, just because you can command a premium because you're a repeat founder or whatever. And to an extent, we were in a position to do that. It's not always the best idea, right? Because you have to get future investors, and there's a point beyond which nobody cares who you are. Before a company has performance or can be measured by objective metrics, it's measured in part by how good an idea is this and who are the people that are involved, right? As soon as you launch something like we have now, we're measured based on two things. How many people are using it? How much revenues do you make, right? And there's no amount of Nick is a great guy or Renee is an accomplished entrepreneur that's going to overcome, wow, they haven't done crap with their money.
And were there situations where, like funding maybe was more difficult than expected, or, maybe the strategy you took wasn't as successful, or maybe terms weren't as favorable? Or what kind of difficult experiences did you have on the fundraising side?
Look, I would say, there's been a few. I would say that the most interesting one was with Heal. When we raised the round for Humana, we spent, before we met Humana, probably 4 months pounding the pavement, and everyone knew who Heal was. And a lot of the VCs up here in the Bay Area use Heal, right? And they knew it. There was familiarity, and the company was well known, and people liked the product, and the reviews were great, and the revenues were there. And for one reason or another, we just weren't getting there. And then I remember we got a term sheet in December of 2019 at the point where we knew Humana wanted to invest, but their due diligence was just starting, and that process was a 6-month process, right? Like, hey, we want to do this, but we won't give you a term sheet or anything binding until we finish due diligence. And they didn't finish, due diligence took 6 months, right? They ultimately invested on July 16th, 2020, after sort of saying they want to do it in December of 2019, right? So if you think about that, that's a long time. So at around that time, we got a term sheet from another VC fund, right? After all that pitching and whatever. And it was a weird thing where we're not late enough for this kind of round, but we're too early for this. We had a lot of interest, and no one was just biting. It was just, and then we get this term sheet from another VC, and we think Humana is the right partner for us. They're a great investor. They'd be strategic. They can bring us customers. They're paying a much better valuation, et cetera. But also, look, we're spending a fairly high burn rate every month, and we don't have an investor right now. There's no guarantee Humana will invest, right? Whatever in their due diligence. Not that we thought there was anything to find, but if for some reason they found something they didn't like, or changed their mind, or the CEO changed, or the stock price fell, or whatever it is, right? All of that stuff can affect an investor coming in, and we have to make that decision. Hey, do we want to take this less optimal term sheet, or do we want to bet on the fact that we will make Humana happen? And ultimately, we obviously made the right choice.
So it looks like you gambled again. Going back to the early '90s when you had the chance to sell, and you kind of ended up getting the lower price. But this time, maybe not apples to apples, but a similar situation where you kind of waited. And this time it worked out. They actually came through, which, is super risky with strategics because, senior management can change, things can change at any point in time. I had an experience where Samsung was acquiring us and we were getting everything was perfect and awesome. And then management changed. There was corruption at the top. And the day that the new CEO had signature authority, every deal on the table was killed, regardless of what it was. It was just like, timing killed.
Yeah.
And so I guess what made, if you can share details, great. If you can't, understand. But like, what made that term sheet, back in, December 2019, not attractive to where you were willing to?
I mean, it really was a lowball valuation. I think they got the sense that we were desperate, and while we were eager to get the round, we weren't desperate, and they tried to take advantage of it. And so it was a good investor that would have brought good money in. And if Humana fell through, by the time Humana did fall through, we'd actually have money problems, right? Like, and so in that sense, it became bird in hand, right? Hey, I can close this round in a week or so, and whereas this other thing I cannot, is not for sure, and it's going to take 6 more months. That's a tough choice that you have to make.
And sounds like you made the right choice, brought the right partner in, and led to a successful exit. So you kind of get to have the win story there. So let's switch back to Together by Renee. You've got to this point where you conceptualized the idea. You went and raised money quickly. I guess, what was the story here in terms of how much you were targeting on raising? Why were you targeting that much? And at what stage were you guys at? Was it just a pitch deck at this point? Did you have product built? Did you have the team assembled?
It was just a pitch deck, for the seed round. And it was then when we did the seed extension, we had done a pilot with some great data, right? But again, this time around, the process for the seed and the seed extension were incredibly easy and straightforward. Obviously, now we have to soon go raise an A round, and that will take sort of a lot of, I'm preparing for, hey, look, health tech is hard, and get as much progress as possible. One of the things that happens is in a good market, companies will get great term sheets despite their lack of progress. In a bad market, even companies with progress sometimes won't get term sheets, right? So you have to prepare for the worst and hope for the best, but sort of prepare for the worst. And we've built around knowing that we have to do that.
Well, I think that's smart of you, especially coming out of pretty much every major market up and down that we've had in the last 25 years.
Yeah.
It sounds like you've managed your expectations well, because I'm still dealing with founders that, come to me expecting to raise, capital at absurd valuations with minimal to no substantial traction.
Yeah.
And just haven't had that dose of reality, just quite yet, albeit most have now kind of come to terms with, current market forces. But it sounds like you've already mentally prepared and are setting up the company to be prepared.
Well, and one of the things that I would say, one of the mistakes that entrepreneurs make as we come close to the end of the hour here is they obsess over valuation, right? Valuation is important because you structurally want to show it going up with each round. Valuation is important because you want to protect your ownership. But beyond that, it really isn't that important. Whether you do your A round at a 30 pre or a 40 pre will make ultimately not that much difference relative to, did you bring in the right investor, and are they going to help you perform for the ultimate exit? Because the only valuation that matters is your last one, right? And the other part of that is that if you set yourself up and go, "Ooh, I got the maximum possible valuation of 100 million pre," and everyone else was saying 30 million pre, it isn't like the 100 million pre is necessarily a good idea. It's only a good idea if A, the market keeps going up and not taking a dip between those two rounds, and B, you perform the heck out of the money you raised so that you can command an even higher valuation the next round. Otherwise, you're looking at doing a down round, and that feels like you somehow failed, even though it just might be that you raised your last round at too high a price. So I'm never particularly, valuation is almost the last thing on my mind, right? The terms, the control, the board members, the structural changes, and of course, is it a good investor who has a good reputation in the market and can really help me grow and succeed? That is always going to be way more important than the valuation.
So what are some terms that are important to you? What do you try to avoid and what do you try to control?
So number of board seats is always important, right? Do they want truly independent board members, or do they want, hey, we're the VC and we're going to put on one board member, but we're going to pick the independent and put them on, and we're going to pay them. Okay, so if you work for XYZ venture capital firm and you're on my board and they're the ones paying your check, who are you going to vote with? You're going to vote with the people who pay your check, right? So that's an important term. Making sure liquidation rights and pro rata rights and everything are very standard, right? Not disadvantageous to the investor, but not overly advantageous either, right? The stuff some investors will try to stick in a term sheet with, and that's the hallmark of a good investor, is you get a term sheet or investment documents that are clean. I remember the seed, when we did the second half of our seed round, when Pride Capital gave us the term sheet, they sent documents, and I've had the same lawyers, corporate lawyers, for the last 20 years across all these different companies. And I remember the partner saying, "Nick, this is the first set of documents I have ever seen that is, I don't have a single comment on. They're perfect," right? That's a credible investor. That's a real person. So when your lawyer chokes all over the oh my God, you're giving up this and you're giving up that, believe me, when you're starting a company and you're eager to raise money, you're going to think, oh, who cares? I got one more board seat. Who gives a crap, right? The stuff comes back to bite you. It really, really does. So it is always worth spending the time to at least try. Yeah, maybe money is better than no money, or if those are your only choices, but it almost never is the case. If VC A is willing to invest, then the second VC is willing to invest. And ultimately, you'll find someone who wants to invest on your terms, right? And I think it is worth chasing that, because it can be very demotivating when you all of a sudden feel like all I am is the hired help in my own company.
Oh, that's well said. And it's also important for founders to keep in mind that whatever precedent is set in, say, your seed round or Series A round, is a precedent that will be the baseline moving forward for most investors. So if there's a lick pref term,
if you make that too high, now you're operating from such an insane baseline, no one wants to come into the company.
Exactly. So, Nick, you've been sharing some amazing insights and stories that I think a lot of founders will benefit greatly from, just the depth of experience and the length of time you've shared capital. I'm sure there's a lot more interesting stories that we could probably unpack over time, but Really appreciate you joining us. Is there anything else that you want to share? Maybe a final tip to founders that you want to leave them with?
Look, I would say 3 very great things. One, do your homework, right? Don't just, well, I'm talking to VC, but everything is easy. It's on the internet. I read the partner's LinkedIn, read the firm's bio, know their other investments, know what stage they're at, know who you're meeting, do all that homework, right? The more you do, the more impressed people will be, and the better your round process will go. Number 2, right? Then these sound like completely contradictory things, which is have a real plan, one that you believe and one that you think you can sell and passionately talk about. And the third is the exact contrary to that, which is you sort of got to go for it and not give up, right? Because you don't know, right, what combination of factors will bring a VC in versus out. You're never going to know that, right? So you may as well be extremely well prepared and don't hesitate to ask anybody. The worst thing I always say this, the worst thing an investor can do is say no. They're not going to spit on you or beat you up for pitching them. They're just going to say no.
Gotta try at least. Great insights. I appreciate that. What's the best way for any listeners if they wanted to get in contact with you or learn more about you?
Well, if you want to learn more about our app, and we'd certainly appreciate all of you listeners trying out Together by Renee. It's fast. It's a free, secure health care assistant. I guarantee you'll like it. It's available on the App Store at togetherbyrenee.com, togetherbyrenee.com. Not.com. What am I saying? Together by Renee on the App Store. Together by Renee. Just the word Together by Renee. If they want to get in touch with me, just LinkedIn. Look for me. I'm the Nick Desai that used to work at Heal. There's a few Nick Desais on LinkedIn, but I'm the one who used to work at Heal.
Awesome. So we'll make sure to link those in the description of the podcast. But just to, leaving with that note about Together by Renee, I guess, what should someone expect as far as the usage and the value proposition of Together by Renee?
Look, again, not to sound like a shameless plug, but everyone should try it out. It's a really, if you have chronic disease like obesity, diabetes, hypertension, heart disease, or if you are caring for an aging loved one, or if you're caring, or if you have your own chronic health issues, try the app and you will feel like, wow, I didn't know all this was possible in any app, much less all in one app.
Awesome. I'm glad you got to share that. And, having some elderly grandparents and parents that'll be on that ship soon. It's important to know. I'll be sure to check it out. Nick, again, thanks so much for being on the show. Really appreciate your insights and stories, and look forward to getting this out to our audience.
Awesome. Thank you so much. I had a good time.